everyone, and welcome to today's Engaging for Missouri webinar. I'm Alice Roach from the University of Missouri, and I'll be your host today. With each of these 30-minute presentations, we intend to share research-based insights that leaders like you can apply in your own work to benefit and strengthen the state's agriculture and food system, hospitality sector, economy, communities, and families. Today, Scott Brown and Bob Maltsbarger will share a presentation focused on Missouri Farm Income Outlook. Before we begin, I do want to share a few housekeeping items. First, we'll close with a Q&A session. Those of you who have connected today via your computers may submit your questions in the chat screen. If you joined today by phone, then you may email me your questions at roacham@missouri.edu. Second, all attendees are muted and may not start their video. Third, if you encounter any technical problems during today's presentation, then you can let me know, and I'll do my best to help you troubleshoot. Just send a note to roacham@missouri.edu. And last, we will make a recording of today's presentation available. You can look for an email tomorrow that shares more about where you can access that recording. Plus, you can find an archive of previous Engaging for Missouri webinars on our Division of Applied Social Sciences YouTube channel. So now we'll transition to the topic of today's presentation, which is titled Understanding the Fall 2022 Missouri Farm Income Outlook. Presenting today are Scott Brown, who's the Interim Director of the Rural and Farm Finance Policy Analysis Center at Mizzou, and Bob Maltsbarger, who's a lead economic model developer with the center. So thanks, Scott and Bob, for presenting today. If you could please unmute your microphones and start your video, then we can begin today's presentation.
Thanks very much, Alice. It's great to be able to kick off here this afternoon. So I want to give a shout out being in this interim director role now for 60 days. Number one, Dr. Sarah Lowe started the center and certainly left me a good opportunity to build on the base that she started. Beyond Bob, who you'll hear from in a few minutes, shout out to Taylor Ann Washburn as well, who's really been important to the development of RaFF. So it's great to work with a bunch of colleagues as good as both Bob and Taylor Ann. So I just want to spend a minute or two here to talk about kind of the role of the center as I see it, and then turn it over to Bob to get into the specifics of Missouri Farm Income. So I will say it's nice that we can talk about this new Missouri Farm Income forecast that we have together. For us, I think the most important thing from a policy perspective is we want to be able to grow this into other states as well. We're going to be already talking about Nebraska farm income here, maybe a release tomorrow, as soon as tomorrow, but being able to build and look at why are things different. Our colleagues in FAPRI are doing national farm income estimates that are very critical as Congress does work on farm policy, but being able to really shed more light on why is Missouri different than Nebraska or different than other states. That's really, I think, the add that we hope that we bring from this center. Ultimately, I think we want to help Congress as they're making policy to understand what does it mean regionally around the country, and I think this provides just another way to do that. Next slide. So we did publish the Missouri Farm Income Outlook on September 13th. It's kind of this gauge of what do we see happening in Missouri. I will remind all of us that USDA gave us their first 2021 estimate of Missouri farm income at the beginning of September. And that's really our stepping off point as we look ahead and Bob starts to talk to you about the forecast. We will be in a mode of providing twice a year updates on the Missouri Farm Income Outlook. Well, again, we'll be working with our colleagues on the FAPRI side for the sector and national level information and be able to boil that into Missouri Farm Income Outlook. So again, I appreciate having the chance to visit with you all for a couple minutes, and I'll turn it over to Bob.
Okay, well, I'm going to get started first at a high level of what our modeling approach is, and then we'll jump into some numbers. So our projections that we're using for the different state farm income outlooks is a hybrid approach. It starts largely with combining the applied agricultural economic modeling system with state-specific feedback from in-state collaborators. And so our collaborators provide feedback because they are working to validate the estimates because they're incorporating on the ground information that they can receive. So that depending on the state and depending on which collaborator is, a lot of them so far are extension associates, extension professors, and they work directly with farmers, and they get feedback and they provide feedback of what's happening in their state. And then for this outlook, it's specifically for Missouri. And that is one of the big benefits that we're using. So it's not just what I can put together real simple, not simple, but what I can put together as an outlook for numbers, which I love the modeling portion of it, and I can do a pretty good job in my mind. But getting that on the ground feedback, kind of providing some truth to what's happening in that state will actually make the estimates that we're putting out much more realistic, and I think add more value to the state itself. So each state that we cover incorporates this modeling system, has an accumulation of individual equations that are customized to the idiosyncrasies of that state, and it basically is built to capture the unique crop and livestock mix of the state. And then it allows us to provide twice annual 10-year baseline outlooks for the state farm income, as well as the capability to estimate financial implications of different market shocks and policy shifts as those needs arise. The benefit for decision makers is that we are expanding our coverage to multiple states, which Scott mentioned, and those stakeholders that are interested will hopefully be able to garner more insight on how policy impacts not only the nation, but how it can vary from state to state and across the regions of the United States. Key insights at the high level for our outlook this month is net farm income in 2021. For those of you that pay attention to it, was a new record. It was $4 billion. So that was a pretty big number. And for 2022, this may surprise some people, we actually expect it to grow 5% over that record in 2021. The annual increase is it seems like a big deal because it was a record, but it's still, that 5% increase is a little bit lagging from what the August factory baseline update that came out. They have the national net farm income increasing 6%. So it's pretty close on par, but it does not increase at the same rate as the national. And that's partially built because of the different effects of the national average crop and livestock mix as opposed to Missouri. So how do we get to that $200 million bump to reach a $4.2 billion new record in net farm income? Well, the short answer is it's complex, but hopefully that waterfall chart on the right will kind of sums together some of the different categories. And so it simplifies the outlook a little bit. So the green bars are the rising bars. You can see that net farm income is largely improved because of increases in receipts for crops and livestock, especially crops this year for Missouri, as well as a smaller increase in crop insurance indemnities from a change from 2021. The challenge is that as prices increases, so generally do expenses. So production expenses increase in 2022. And at the same time, we see a decrease in government payments. So for 2022, the key takeaway is that the strong increase in receipts for crops and less so for livestock is largely being offset by the higher input costs, as well as lower government payments. And then the next couple slides, I'll drill down a little bit more detail into each of those, and we'll get a better picture of what's going on each side of the crop mix. So for crops, the crop side, we saw stronger prices in 2021, helping to encourage expansion of planted area in Missouri for this year. This pushed the Missouri top 7 crop area to expand to nearly 14 million acres. And that's a level we haven't experienced since 2014 in the state. Soybean planted area increased the most, and it hit 5.9 million acres this year. And that's only 50,000 acres behind the last peak that we saw in 2017. Wheat area increased 160,000 acres, while corn was flat around 3.6 million acres for the year. The rest of the top 4 corn crops actually declined year on year by about 90,000 acres. This spring, as many of you know, we saw some mixed wet, cool conditions across different portions of the state. and that delayed some of the plantings this year. And then we followed that up with more dryness. We have only about a quarter of the state not in some sort of abnormally dry or drought conditions right now, as last week's drought monitor report from the USDA. And these two factors, plus some extended heat, basically had an impact on our expectations of what is going on with yields. So the potential yields this season have declined, and it contributes to 5 of the 7 crops that we cover, the top crops that we're covering for Missouri, basically declining yields and decreasing production for the year. The interesting thing is, despite the decreases in production, because of geopolitical stuff going on, as well as supply and demand in other countries, we actually have prices increasing this year and pulling up prices for not only crops, but for hay, and pulling up receipts for the state of Missouri for crops and hay up $1.4 billion to nearly $1.4 billion from the record set back in 2021. Moving forward to livestock. On the livestock side, we've seen strong consumer meat demand, especially since 2020, and that's been supporting livestock prices pretty much throughout. Although the ongoing liquidation of both the cattle and hog herds tightens inventory to close this year. So the challenge with lower inventories is that longer term, it has implications for what's going to happen to production and marketings in the future for the industry. So as cattle inventories and hog breeding herd continues to decline, we see fewer market-ready animals coming up in the next few years, and eventually more head will need to be retained to rebuild that productive herd. So for dairy, poultry, and eggs, it's a little bit of a different story. We see declines in production this year for each of those categories. And there's different things that have caused that, of course, but the avian influenza is being one of them. But that is being largely offset this year, at least for 2022, with higher prices. So those higher prices have supported those 3 categories to have stronger receipts. But moving forward, as production turns around and production turns higher for those categories, especially poultry and eggs, in 2023, it's not going to be enough in our expectations to offset the weaker prices, and we expect, or at least we're projecting at this point, for receipts for eggs and poultry to decline in 2023. In concert, the story for livestock is somewhat similar to crops this year. After having a second best livestock receipts in history in 2021 for Missouri, an increase in receipts in 2022 sets a new record for livestock across the state. Following this new record is the challenge I already spoke about, as we see changes across the livestock industry, weakening livestock receipts in 2023 and then across the next few years. For expenses, that big thing that always offsets receipts when they go up. The key is for 2022, we have increases in every expense line item in the value add tables for Missouri. This is the largest increase in expenses basically since 2020. And those largest expenses go to 3 major categories: fertilizer, feed expenses, and fuel costs. The state level spend on fertilizer in 2022 increases $620 million from 2021, which ends up being about $1 billion higher than the spend in 2020. As crop prices rises, so do feed expenses. So livestock producers are facing larger feed expenses, and we project those costs increasing $165 million in 2022. And that's combined with 2021 to $850 million across the last 2 years. And then fuel and oil expenses increased $76 million in 2021, and then another $108 million in 2022. So overall, the combined increase in these input prices account for the majority of the rise in expenses to Missouri farmers across both the last 2 years. Well, 2021 and then again in 2022. So here's the interesting part. So the bottom line to Missouri farm income, I've already mentioned it, it's a new record of $4.2 billion. But how we come about that is despite the challenges of this year, which I spoke about with delayed planting, some drought conditions are scattered across the state and still affecting what's going on in the state as far as moisture, the effects on yields, the effects on forage and the expenses thereof for livestock producers, higher fertilizer expenses as we face the geopolitical concerns across the world, sanctions for Belarus, effects in because of Russia, natural gas costs and fertilizer plant closings in Europe, and then the effects thereof also on fuel. So those aren't the only ones, but those just happen to be the biggest ones in 2022. So the other ones, like I mentioned before, all are increasing, but the total net farm income for Missouri is still projected to reach $4.2 billion. And that's largely because also those effects on prices as we're going into this year. We saw prices spike between February and June. They started coming back off quite a bit as the Russian and Ukraine interactions continue. But despite them coming off, they are still relatively elevated historically. And that's really what's helping receipts for 2022, especially for crops. One thing I wanted to make sure to point out is these are preliminary numbers. I mean, just Monday, I was driving back and forth to Kansas City, and you could see along the interstate a lot of corn harvesting going on, or at least it's picking up much more aggressively this week as we've had some pretty extended dry weather, kind of mild weather this week. And even on the way home last night from work, I saw one farmer, a neighbor of mine, actually combining a field of soybeans already. So across the state, until yields are realized, all these numbers are preliminary. And so yields could be either higher or lower than what we projected late August to get these numbers. And given the drought monitor, we know that it's been dry, it's been persistently dry. How that affects soybeans in August, we're not 100% sure yet. But I have heard that despite the pod counts, it's possible that the yields will be more affected by the seed size this year than the pod counts themselves. So it could be much weaker on the production side. Unless prices at the national level compensate for that, we could see a revision downward on receipts pretty hard when we update in March for this next farm income report. So with that being said, weather, geopolitical factors continue to play a major part in how we expect farm income projections to evolve both at the Missouri level and at the national level moving forward. Heading past 2022, which that's what most of my numbers were looking at for my charts, into 2023 and beyond, we do expect commodity prices to start to slide, with exceptions of cattle prices next year. And as commodity prices have a tendency to slide faster than input prices do, input prices tend to be sticky. And because of that, we have a bias or a change into the next farm income year, and that it's going to be a bit tighter than what we're expecting now. But even with that decline that we're projecting at the moment, still the average of net farm income that we have in this baseline outlook from 2023 through 2025, even 2026, is still much higher than what we were experiencing in 2015 through 2019. So that's a key point that we can expect at the moment. One of the things that I've also been looking at that I didn't include in the graph was those kind of net farm income in real terms. Even with that decline in real terms, we're still looking at net farm income in real terms in 2023, 2024, 2025, similar to what we were experiencing in 2013 and 2014. So that gives you an idea of what we're looking at now for 2022 farm income, but also kind of an expectation that things are going to be a bit tighter in the coming years. As we know, fertilizer is a very volatile prices right now, especially nitrogen. And if the conflict in Ukraine and Russia continues to escalate, the natural gas pipelines continue to be shut off for Europe, it is likely that those expectations, the projections that I had for nitrogen prices going into this can be much higher and persist at least longer at a higher level than I was previously projecting, which would also affect the net farm income for 2022 on the back end once those numbers develop and are actually realized across the state. So that's kind of my wrap up for now. And I'll go and move forward to the final slide here about Engage for Missouri. And Alice will come on and introduce us with some questions.
Yeah, thanks, Bob. I appreciate you and Scott presenting today. If you have questions, please go ahead and include those in the chat screen. We do have time to take your questions. And I want to start with an attendee question, Bob. You shared about how feed, fertilizer, and fuel prices really cause input expenses to increase. This attendee question is asking about other crop expenses, such as chemicals. Would they be a higher proportion of inputs than fuel and oil?
So the reason I pointed those out specifically as opposed to the other ones, I have every line item on the expense side increasing in 2022. But it's just the magnitude of change is why I pointed out those. Pesticides is another one that increases pretty dramatically. Interest expense is another one we expect to go up. We see the Fed increasing interest rates, and that will affect the operating loans for those short-term operating loans that farmers and producers take out each year. And so we haven't had those other ones increasing. It's just I highlighted those because those were the largest magnitude of changes from 2021 and even 2021 over 2020. Pesticides is a big one. Interest rates is a big one as far as magnitude of change, as well as livestock purchases. As we've seen hogs and cattle prices increasing for those people that are buying those feeder cattle, buying those feeder pigs, that means their costs for purchasing those feeder animals are also increasing at a pretty strong rate for 2022.
Excellent, thank you. Another attendee question here reads, how does Missouri's change in net farm income from 2021 to 2022 compared to trends for the US? And if the trends are, or the changes rather, are significantly different, then what are some factors that play there?
So I did mention that the Fabric came out with their August farm income for the national level. For the United States, their increase in net farm income from 2021 to 2022 was 6%. For Missouri, we have it at 5%. So it is lagging a little bit. In part, it's due to the crop and livestock mix. So on the benefit to Missouri and why it could have been higher, for example, Missouri has a larger share of soybeans. So we have a larger share of soybeans. Soybeans generally do not apply as much fertilizer as corn, wheat, rice, cotton. And so because of that, those farmers that are producing more acres, because it went up in soybean acreage, but not in corn this year, it would have been a potential benefit for a lower fertilizer expense. But on the other side of that, we had a lot of herd liquidation in 2021 in Missouri. But this year, even though we have strong herd liquidation in cattle, and it's not at the same level as what is being experienced down in Oklahoma and Texas. So the Southern Plains were hit so much more dramatically on their severe droughts and exceptional droughts this year that the lack of water in stock ponds, the lack of moisture to even produce hay or grazing, there's a lot more liquidation down there. So that forces those cattle to be sold. The herds are being liquidated, and all of those sales go into the bottom line. And on a national average, because those states that liquidated the herd so hard, it increases the cattle receipts at a stronger rate than what we see in Missouri. But that would have been kind of a flip-flop from what we had last year, because we had a lot of liquidation last year in Missouri of cattle, and this year it's going to be in other states. So the receipts for those are not quite on par with what you see in some of those other states, which pushes up the national receipts faster, and then that falls down into the net farm income as well.
Yeah, great explanation there. Thank you. You mentioned rate hikes as a possible concern for producers who have operating loans. It's going to increase interest expense for them. I want to look at history a bit for a minute and talk about how rate hikes were one factor that affected farm finance in the 80s, which were, that's a tough decade for US farms. So can you speak to what makes today's situation either similar or different from what we saw in the 80s? Absolutely.
So part of it is even though interest rates are increasing, they're still relatively low historically. That's a big part of it. So even though it becomes more expensive to borrow money, it becomes more expensive to take out those loans and pay for that interest. It's not at the same level as the interest rates that we were seeing in the 80s. So during the Volcker times, when interest rates are going up, pushing down inflation, interest rates got much, much higher. So because of that, that means any dollar you borrowed was more expensive to borrow. also, according to my colleagues in Extension that follow this much more closely than I do, they show and they talk about the asset ratios and to cash ratios. And so there's, my understanding is there's a lot more cash on hand for farmers. So many of them are in a better situation now than they were in the 80s. And so when I was at a conference on Monday, Nate Kaufman from the Kansas City Fed was speaking, and it basically, he had some of the same positive outlooks for 2022 and even heading into 2023 because of the asset and cash balance that farmers are holding right now versus what we were experiencing back in the 80s.
Thank you. I appreciate that. So you talked about how strong commodity prices were one factor that encouraged Missouri farms to grow total crop acreage under production for this year. I know it's really early, but what are your initial impressions of how planted acreage, the total, may change in 2023?
Okay, I am going to move up on my table here. I have my tables in the background here so I can look at these quick questions quickly.
Yeah, thanks.
So for the state of Missouri, for those top 7 crops, which includes hay, we have acreage expanding another 270,000 acres in 60,000 acres in 2023. So we do have some increases, but there's certain crops that we don't have increasing. So there's like cotton's coming off a little bit. Corn's not as competitive, but we have an increase in hay and some rice, a little bit in oats and soybeans. So we still increase on a net for those top 7 crops that include hay. We do have increases in area for 2023, but it's just not as strong. And part of that is even though we have strong prices, they weren't what the highs were back between February and June, but they're still elevated historically. But we also have high expenses, and those aren't, even though it's possible that they could come off in 2023, they're not going to come off nearly as quickly as commodity prices do. And that's going to play a big part in how much more that we're going to plant. So there's going to be a limit on how much people can profitably expect to put in the ground and pull back out. And part of that is the prices are being offset, and those expenses aren't going to come down as quick as the commodity prices are. And that's pretty typical historically because they have a tendency to be a bit more sticky.
Excellent. Thank you. Can you talk about wheat a little bit? Because the conflict in Russia and Ukraine have really increased the frequency that we hear about wheat markets and the dynamics there. So are Missouri producers interested in producing more wheat? Is there opportunity to produce more wheat because of what we're seeing in the wheat market?
It's a yes and no question. So there's opportunities. I know that the USDA is coming out with more potential double crop insurance, but the expansion of those is still to a limited number of counties. And even people that double crop aren't necessarily always covered under that insurance. But the combination thereof is possible. We could have more farmers going to a double crop situation, but part of that depends on fall planting opportunities. You could say that you could want to put it in the dust and hope that bins will bust, which is a cliche I heard on Monday. But the challenge is that if we have this extended drought in through the whole fall, at some point you don't necessarily want to risk putting wheat seed into the ground just in the hopes that it will get some moisture at some point. So some of those farmers may be a little hedging their bets a little bit and just doing full season soybeans next year instead of double crop wheat and soybeans. We are back into the La Nina again. We were temporarily into neutral conditions earlier this summer, and La Nina typically means for the Southwest United States drought. But this year it's extended over into more in the southern plains. And sometimes a La Nina means some dryness in December for Missouri as well, and then through the Midwest. So because of that, there is a little bit of uncertainty about what's going to happen longer term. Right now, some of the expectations in the industry, the people that forecast La Ninas and El Ninos, they have the La Nina kind of expected to go neutral conditions sometime between December and February. So if it's going to be dry from now through February through most of Missouri, it may not make sense to put wheat in the ground just in hopes we get some rain and it can recover and develop in the spring. So it's there, at least some of the incentive there. Wheat prices are high, but it's not necessarily going to play out that Missouri farmers are going to plant more wheat.
Got it. Thank you. I want to touch on one other question. So you talked about the high fertilizer prices in the past year, and some of the upward price pressure was attributed to supply challenges. To what extent have those supply challenges been resolved, to the extent that prices can begin to retreat?
That's the challenge is even just early last month, before the additional aggression or increased aggression from Russia and Ukraine, I had hopes that at some point this fall and into early winter that there would be a resolution. Natural gas would pick back up. Those nitrogen plants would basically come back online in Europe, and it would ease some of that supply pressure for nitrogen that we're seeing around the world. There are other places that produce it. China is a big producer of urea as well. We do have increased number of plants of nitrogen currently that we did 20 years ago in the United States. They had fallen off for decades and then they picked back up. And so we're a little bit better situation than some countries for nitrogen, but the supply constraints because of the European natural gas situation at this point have not resolved. And there's an indefinite amount of time before it will be resolved. So that we're seeing anhydrous prices pick back up. We had a lull kind of between that April, May, and July timeframe. And as people are starting to pick up purchases again, anhydrous prices have been picking up, and people try to lock in some of those anhydrous prices. If it does not fall back off, because some farmers will probably wait and hold off hoping for lower prices in the spring if they don't do winter application. If that does happen, it's possible supplies could ease and prices could come off in the spring, right when the demand picks up. But it's right now it's not looking too promising. So it's pretty uncertain, but the supply situation has not resolved itself as of yet. Those geopolitical concerns continue to be sustained, and we don't really have an endpoint on the horizon that I can see yet.
Great. Well, thank you for explaining that. I do appreciate it. Thanks to Scott and Bob for presenting today, and thanks to our audience for joining us. It's time to go ahead and close for the day. You will see a post-webinar survey will either have already loaded in your browser or it will load in your browser soon. Please consider responding to that survey, as we'll use the results to improve the webinar experience and also brainstorm future webinar topics. Again, you should receive a recorded copy of today's presentation plus the slides from today's presentation via your email within about a day from now. You can join us for our next Engaging for Missouri webinar on Wednesday, October 19th. Andrew Zumwalt, who is an associate teaching professor in our personal financial planning program, will share a presentation titled Non-Transitory Inflation, a conversation on adjusting personal finances for persistent inflation. So again, thanks for joining us and enjoy your Wednesday.